We have many attendees today, and I'm certain that we have a great number of our current investors. So I want to first thank our investors for their trust and partnership. This will serve as a real-time update to our portfolio construction. We'll have an opportunity for Q&A, and we'll facilitate that at the conclusion of the presentation. For those of you that don't know Pinnacle Partners, we are an early mover in the execution of the Opportunity Zone legislation. Our first fund was formed in 2018, soon after the legislation was enacted. We've since executed on 9 discrete funds, capitalized close to $600 million of OZ development. We will deliver approximately 1,300 multifamily units, our product of choice. And by creating 9 separate and distinct funds, we've gotten very good at the execution methodology, and in particular, invoking institutional quality underwriting, ensuring that we source the highest quality projects that stand on their own before the tax benefits are added. We think that's our unique edge. So just a very quick primer before we move to John. Why invest in opportunity zones? We're not going to go through the extensive kind of overview of the program. We're going to assume that the audience is generally familiar with opportunity zone investing. To score the point as to why opportunity zones can be compelling as a tax shield, I refer you to the graphic here on the right side, my right side. This was on Monday, April 18th. Fairly well-known CNBC contributor Tom Lee of Fundstrat estimated that Americans paid last Monday $1 trillion in capital gains tax, the most ever. And given current volatility of the markets, as he notes in the tweet, lots of furious cash raising to fund taxes. Well, for those that aren't aware, there is a tax shield, a very efficient tax shield available in opportunity zone investing, where you invest capital gains and you enjoy significant tax benefits, as well as exposure to institutional quality real estate, which serves as diversification, which serves as a non-correlated asset, many call alternative asset or real asset, which we think is quite valuable given the current inflationary cycle. So I thought that certainly made the point. And opportunity zone investing has been in place since 2018. We are going to go to John Sciarretti, who is partner at Novogradac. Novogradac is the nation's leader in the application of federal tax programs. That could be LIHTC, but certainly has been opportunity zone investing. They have influenced policy. Most recently, last week, they had their spring opportunity zone conference. And so we're going to go to John to describe the state of the OZ marketplace, the number of inflows that have come into the program, and report on some recent proposed legislation that would extend and potentially expand the OZ benefits. On your screen at the moment are the 2 benefits enacted and in place today. If you're to invest in an opportunity zone, you will qualify for investing capital gains, short or long term, temporary deferral of the capital gains tax, and ultimately permanent exclusion or tax exemption on the appreciation derived from the real estate investment. John, go to you now for the latest real-time update on opportunity zone market and proposed legislation.
Thanks, Jeff, and thanks for asking me to be here. As Jeff said, I'm with Novogradac and Company. We're a community development finance group, primarily tax incentives around real estate. And we're very active in the opportunity zone space, have been since inception. And with respect to the marketplace, we actually conduct a survey that we've been conducting since, I'd say, early 2018, which is when the investing first started. And I'm happy to report that based on our survey, investing has been very strong. We don't capture the whole marketplace; it's anecdotal, but we we do survey about 1,000 funds. And they're all multi-family, multi-investor funds. So there's lots of opportunity zone investments that, are captive or sort of under the radar. And so we know that we don't capture the whole marketplace. We think it might be about 25%. So the real numbers are most likely 3 to 4 times higher than what we capture. And when we look at 2021, it was a huge year for opportunity zones. We had surveyed $20 billion invested, and that was 61% over the 15 billion at the end of 2020. And so there was a sort of 61% increase in our survey results to 20 billion. And there was a lot of questions as to whether the basis step-ups of 10%, what was left, you get this 15% basis step-up. 5 sort of went away a couple of years ago, and you had this 10%, and last year, the end of 2021 was the last year to take advantage of that, as to whether that would slow people down. It was a huge year in 2021. The stock market was, record highs, looming inflation. There was lots of M&A activity, lots of gains. And so there was this sort of question whether we would see this continuous investment opportunity zones in 2022. And in our survey, again, it's anecdotal and just a subset of the marketplace, showed $4 billion invested in the first quarter, which was 3 times what was invested in the first quarter of 2021. So by all indications, this momentum is continuing in opportunity zones, despite the fact that, we don't have the basis step up. When you look at the math around the basis step up, it's probably worth about, the 10% was worth less than 50 basis points. So if you're looking at a 10% investment, 10% return after tax, let's say, the opportunity zones itself is going to give you 300 to 400 basis points on that, on an after-tax basis, based on the let's say a multiple, maybe 2 at the exit, and then not realizing, not having to recognize the recapture on the sale. So you're talking about, instead of getting 14%, maybe you get 13.5% after tax. And so it's just in that math, that 10% didn't mean much. So I didn't expect folks to stay away from the program just because that incentive wasn't there. But that's sort of where the marketplace is anecdotally. We're seeing this, energy continue to invest in opportunity zones. There is, as Jeff said, some proposed legislation out there to extend the program. The legislation is actually sponsored by Senator Cory Booker and Senator Scott, who were some of the original co-sponsors of the bill. So it's bipartisan, it's bicameral. We also have some heavyweights in the House. And so we think it has, its best chances, any chance of passing if we get it into a wider bill. I mean, these bills don't, come to the floor alone. They're usually tucked into a wider bill. And so we expect that if we were so lucky to see it pass this year, it probably wouldn't be until a lame duck session, assuming it is a lame duck session. At least that's what all the signs are. But there's typically a year-end tax extenders bill that is usually bipartisan, and usually both houses cooperate around the tax extenders bill, even if it is a lame duck session. And so we expect the best chance for this passing this year would be in a tax extenders bill at the end of the year. And so we're hopeful. If it doesn't get into a wider bill this year, again, it has to be sort of a tax title bill, then the fact that it's bicameral and bipartisan, even if the majority went Republican, we think the fact that it's bipartisan, bicameral, that the Biden administration wouldn't be likely to veto the bill. So it's sitting pretty strong, and it's it not only has an extension, which we'll talk a little bit about, but there's some trade-offs that the Democrats were interested in, like reporting in the sunsetting of some of the high-income tracks. Very few tracks out there, very low, small percentage of tracks that they've been sort of wanting to phase out or sunset in the program. But the extension itself is a 2-year extension. There was just sort of took about 2 years for the momentum to really start in the program as we waited for regs, and folks just having to get through the learning curve of understanding the program. And so that's why they're asking for 2 years. What that means is that currently in 2026, that's the general inclusion event for folks that invested from 2018. And it would just extend that for 2 years, even if you've already invested. So it's kind of a nice extension. It's not like there's 2 tranches where one tranche ends in 26 and one tranche ends in 28. Everyone would get 2 years. And then it also provides for an opportunity to reinstate both the 10% and the 5% step up. The way the 5% works, because you had to hold your investment for 7 years, which we only have 6 until 28. And so the 5% step up, the bill moves it to a 6-year investment term. And so if it were to pass and you were to invest by the end of the year, that's a tight or a narrow window, then you could get the 15%. I suspect probably it's not going to enter a wider bill as it sits today. There'll be, we have a working group that we're actually making comments to the legislation. And then a lot of times when things pass a little later, they might provide for this 15% to still survive, where, they somehow make it 5 years or something like that if the bill were to pass, later or in a 2023 date. And so anyway, but that's sort of what's in that. Another feature of the proposed legislation is this fund to funds concept. And what that means is currently a qualified opportunity fund can't invest in another qualified opportunity fund. So if you were to say if you happen to make an investment in your own fund that you set up and you wanted to go into sort of a multi-investor fund, a lot of times we have to sort of joint venture these things in a side-by-side basis. It makes it complicated, and because you can't under today's law, you can't, a fund can't invest in another fund. And so this proposed legislation provides that a fund can invest in another fund as long as 95% of the assets of this sort of upper tier fund make it to the lower tier fund. And the objective of this provision, I think, is to allow for, smaller funds to participate in a diversified, larger portfolio. And so, we think it's a great feature. It will be widely accepted and have a lot of utility in the marketplace. So that's another feature of the legislation. So that's all I have, Jeff.
Yeah, well, thank you, John. It's a great overview on the marketplace, on the proposed legislation, and really the process to get it enacted. And we appreciate your confidence, optimism that it will be. So let me just, we're getting Q&A.